Standard credit cards. These are the plain vanilla of the credit card world. No rewards, no perks, no flashy metal, just a simple line of credit from a bank that lets you spend now and pay later. Most have no annual fee, and they exist for one job, helping people build credit and handle everyday spending. The modern credit card actually started with a wild stunt in 1958 when Bank of America mailed 60,000 unsolicited cards to people in Fresno, California, and just hoped for the best. It worked. That card became Visa. Standard cards are the foundation everything else is built on, the white t-shirt of personal finance. Boring, but everyone needs one. Rewards, credit cards. Rewards cards are where things start getting fun. Every time you swipe, the card hands you back a little something, points, miles, or cash. Some cards give a flat rate on everything, others rotate bonus categories like groceries, gas, or dining. The whole rewards game kicked off in 1981 when American Airlines launched AAdvantage, and banks immediately said, "We want in on that." Within a decade, almost every issuer had their own program. Today, rewards cards are the most competitive segment in the industry, with banks essentially bribing customers with welcome bonuses worth hundreds of dollars just to sign up. It's the closest thing to free money the financial world offers, as long as you pay your bill on time. If you don't, well, the interest will eat those rewards alive. Cashback credit cards. Cashback cards keep it simple. Instead of points or miles or some elaborate redemption chart, you just get money back. A percentage of every dollar you spend comes right back to you as a statement credit or deposit. Discover invented this concept in 1986 when they launched a card that paid 1% back on everything. At the time, this was considered borderline insane. Why would a bank give people free money? Turns out because people then use the card constantly. Within a few years, every major issuer had copied the idea. Cashback is the favorite of anyone who doesn't want to think too hard about their rewards. No transfer partners, no blackout dates, no spreadsheets. Just dollars, the universal language of yes please. Travel credit cards. Travel cards are built for people who love airports more than they probably should. Instead of cash, they earn points or miles you can redeem for flights, hotels, and rental cars. The good ones come stacked with perks, free checked bags, priority boarding, travel insurance, and the holy grail, airport lounge access, where the snacks are free and the chairs are comfortable. The Chase Sapphire Reserve, launched in 2016, basically broke the internet when it came out. The welcome bonus was so generous that Chase reportedly took years to recoup the cost. These cards become really powerful when you transfer points to airline partners, which can multiply their value many times over. The downside? They mostly make sense if you actually travel. Otherwise, you're paying a hefty annual fee to feel fancy. Co-branded credit cards. Co-branded cards are what happens when a bank and a company team up to create a card that only really works inside one ecosystem. Your Delta SkyMiles card earns extra on Delta flights. Your Marriott card gets you a free night at Marriott hotels. Your Amazon card gives you bonus rewards on, well, you can guess. The first one is generally credited to American Airlines and Citibank back in 1987, and the model has since spread to airlines, hotels, retailers, gas stations, and even sports teams. These cards are loyalty programs disguised as credit cards. They work great if you're devoted to one brand, but the rewards basically evaporate the moment you stray. Buying groceries with your Delta card? You'd get more value from a paper coupon. Business credit cards. Business cards are for entrepreneurs, freelancers, and anyone who's ever filed a Schedule C tax form. The rewards categories are tailored to how businesses actually spend money. Bonus earnings on office supplies, advertising, shipping, software subscriptions, and internet bills. They usually come with higher credit limits, free employee cards, and reporting tools that make tax season slightly less painful. Here's a fun perk. Most business cards don't show up on your personal credit report, even though you usually have to personally guarantee the debt. That means you can rack up big balances without tanking your personal credit utilization. American Express launched the first dedicated small business card in the 1980s, and the category absolutely exploded once the freelance economy took off. If you have any kind of side hustle, you probably qualify for one. Yes, even your Etsy store counts. Charge cards. Charge cards look like credit cards, but operate with one major rule. You have to pay the whole balance every single month. No carrying a balance, no paying interest, no minimum payments. Just pay it off or get in trouble. Instead of a fixed credit limit, charge cards use a flexible spending power that adjusts based on your history and payment patterns. American Express built its entire reputation on this format starting in 1958, and for decades, pulling out an Amex Green or Gold card was a flex. It implied you had enough money to pay everything off each month. The original aspirational status symbol. These days, most charge cards have softened up and allow some flexibility on big purchases, which has blurred the line with regular credit cards. The category is smaller now, but Amex still keeps the tradition alive. Secured credit cards. Secured cards are the training wheels of the credit world. You put down a refundable deposit, say $300, and that becomes your credit limit. From there, the card works exactly like any other credit card. You spend, you get a bill, you pay it. The issuer reports your activity to the credit bureaus, which is the whole point. After several months of responsible use, most issuers will refund your deposit and bump you up to a regular card. Secured cards are designed for two types of people, those building credit from scratch and those rebuilding it after past mistakes. Think of it as putting up collateral, so the bank trusts you. It's not glamorous, but it works. Plenty of people with great credit today started exactly here. Student credit cards. Student cards are designed for college students who are just starting their credit journey. The limits are usually small, the rewards are modest, and the approval requirements are way more forgiving than standard cards. Some come with quirky perks aimed at student life, bonus cash back for good grades, elevated rewards on streaming services, or extra earnings on dining and groceries. The whole strategy here is simple. Banks know that whoever gives you your first credit card has a really good shot at keeping you as a customer for decades. So they get you young. The category got a major makeover after the 2009 Credit Card Act, which cracked down on the more predatory marketing practices, like the infamous tables set up on college campuses offering free pizza in exchange for a credit card application. Yes, that really happened. Store credit cards. Store cards are the ones the cashier offers you at checkout in exchange for 15% off. They're issued by retailers, and they usually only work at that specific store or its sister brands. They come with juicy first purchase discounts, special financing offers, and exclusive cardholder sales. The catch? The interest rates are brutal. We're talking 30% or higher in many cases, which means if you don't pay your balance in full, that 15% discount turns into a financial trap really quickly. Some store cards are closed loop, meaning they only work at the issuing store, while others run on Visa or MasterCard networks and can be used anywhere. Department stores actually invented this concept in the early 1900s, long before Visa existed. Sears, Macy's, and JCPenney were issuing store charge accounts when your great-grandparents were doing their shopping. Prepaid cards. Prepaid cards are the credit card impersonators of the financial world. They look the part, they swipe the part, but they're not actually credit. You load money onto the card in advance and spend that balance. No borrowing, no interest, no credit building. They're useful as budgeting tools, as gifts, as travel money, or as a substitute for a checking account. The format went mainstream in the early 2000s and now serves millions of people who either prefer not to deal with banks or want a controlled way to manage spending. The downside? They offer none of the credit-building perks of a real credit card. Using a prepaid card every day for 10 years will do absolutely nothing for your credit score. It's basically a fancy gift card with a logo. Debit cards. Debit cards get lumped in with credit cards constantly, but they're a completely different animal. Instead of borrowing from a bank, they pull money directly from your checking account. There's no interest, no minimum payment, and no credit building, but also no debt. Debit cards became standard in the 1980s and 1990s when banks started bundling them with checking accounts to reduce reliance on paper checks. They're the default everyday payment tool for millions of people, especially those who only want to spend money they actually have. The downside? Fraud protection is weaker. If someone steals your credit card number, you fight the bank for their money back. If someone steals your debit card number, you're fighting them for your money back, so I try, while your rent payment bounces. Big difference. Premium credit cards. Premium cards are where the credit card industry shows off. Annual fees run from several hundred to nearly $1,000, and the perks are designed to make those fees worth it if you actually use them. We're talking airport lounge access, hotel elite status, annual travel credits, concierge services, global entry reimbursement, and rewards rates that put regular cards to shame. The American Express Platinum, launched in 1984, basically invented this category. It was originally invitation only and aimed at the wealthiest customers, a literal status symbol made of plastic. Today, the segment is fiercely competitive. Amex Platinum, Chase Sapphire Reserve, and Capital One Venture X are all stacking on credits and partnerships trying to outperk each other. Whether they're worth it depends entirely on whether you'll actually use the benefits. Otherwise, you're paying premium prices for a metal card that just looks cool. Subprime credit cards. Subprime cards are aimed at people with poor or limited credit who can't qualify for standard cards. They offer access to credit, which is the good news. The bad news? They come loaded with fees, annual fees, monthly maintenance fees, application fees, and sometimes setup fees just for opening the account. Credit limits are tiny, often just $200 or $300, and interest rates are sky high. Used carefully, a subprime card can be a stepping stone back to better credit. Used carelessly, it's a financial quicksand pit. The category got a lot more attention after the Credit Card Act of 2009 cracked down on issuers who were charging customers fees that wiped out most of the credit limit before they could even use the card.